The average American spends more time planning a vacation than they do planning their taxes, which is why so many people are overpaying their taxes. But what if I told you it's your choice how much you pay in taxes? What you talking about, Jaspreet? Well, as a licensed attorney, who's not your attorney, who keeps a copy of the federal income tax code in his office, I can tell you that this is a rule book, and the financially savvy who understand the rule book can use it to pay less money in taxes legally. In this video, my goal is to show you different strategies that you can use to pay less money in taxes as somebody who works a job or as an investor or as a business owner, but I am not your tax advisor. So if you have specific tax questions, please talk to a licensed advisor in your area, because if you do it wrong, you could face penalties, fines, and potentially even end up in jail. The tax code says if you take risks with your money, you are going to be rewarded with lower tax rates. But if you don't take risks, which in the IRS means you just work a W-2 job, then you're going to be paying the highest tax rates known as ordinary tax rates. Now, I rounded these numbers. These are for single filers, and what it says is if you make under $12,000 a year, you're going to be paying 10% of that money in taxes. For every dollar that you earn between $12,000 to $47,000, you're going to pay 12% of that money in this bracket in taxes. For every dollar that you earn between $47,000 to $100,000 a year, you're going to pay 22% of this money in taxes. For every dollar that you earn between $100,000 to $192,000, you're going to pay 24% of that money in taxes. For every dollar you earn between $192,000 to $244,000, you're going to pay 32% of that in taxes. For every dollar that you earn between $244,000 to $609,000, you're going to pay 35% of the money in taxes. And for every additional dollar that you earn above $609,000, you're going to pay 37% of this money in taxes. And on top of this, we're also going to have to think about your Social Security taxes and your Medicare taxes plus state taxes. That's your ordinary income tax rates, assuming that you take no risk with your money, you're just working a job. But as soon as you start investing your money in the stock market, you get to qualify for tax breaks. As soon as you start investing your money in real estate, you qualify for more tax breaks. And as soon as you start investing your money into building a business, you get to qualify for even more tax breaks. So let me break this down on how you can do this. If this person with a nice mustache makes $100,000 a year from their job, well, first thing you gotta do is pay your federal income taxes, $13,800. Then you have to pay your FICA taxes, that's your Social Security and Medicare taxes. That's an additional $7,600. Then you might have to pay state taxes. Let's assume you don't live in a super high tax state like California or New York. Well, now you got to pay an additional $3,000 or so in taxes on top of that, which means you're going to be left with about, again, I'm rounding the numbers, about $75,000 after all of your taxes, and now you can spend this $75,000. But what happens now if you do it a little bit differently? What happens now if you earn that money from your stock market investments instead? If you own your investment for longer than a year, this profit that you make is called long-term capital gains, and the long-term capital gains tax rates are very different than the ordinary tax rates you pay when you earn your money from your job. The long-term capital gains tax rates at the time I'm recording this video are 0% on the first $47,000, then 15% up to $519,000. Again, I did round these numbers. And then your top tax rate here is 20% on everything you earn over $519,000. So take a look at this. Here, your bottom tax rate is 10%. Here, it's 0%. And here, the top tax rate is 37%. Here it is 20%. So now take a look at this. This person with the beautiful braid also made $100,000 a year. This time they made their money from their investment portfolio instead of working a job, because they worked to build this investment portfolio. Now, your federal income tax rate is not going to be $13,800 after you factor in the standard deduction. Your federal income taxes are only $5,500. Then when it comes to your FICA taxes, that's your Social Security and Medicare taxes, you paid $7,600 here. Out of your job income, you pay $0 in FICA taxes from your investments, because that's what the tax code says. Then when it comes to state taxes, I'm going to be very generous, because a lot of states do not charge state taxes on your investment income, and some states charge a lower state tax on your investment income than they do your job income. But let's just say that it's the same. So you got to pay the $3,000 in state income, which means $8,500 in total taxes, which means you are left with $91,000, a little bit more than $91,000, which means yes, you get to keep a lot more money here than here, even though you made the same amount of money, just because of how the tax code works. But that's just the beginning. Some people say the IRS rewards you by becoming an investor. Some people say the IRS punishes you for working a job. I don't really care what you call it. I just want you to understand how the tax code works, but this is just the very basics. Let's make it a little bit more spicy so you understand now what you can do to pay even less money in taxes. And I should let you know that for those of you that are investors or want to become investors, my team and I have put together a free investing masterclass where I'll walk you through how you can find investment opportunities before everybody else, and I'll show you how my team and I research investment opportunities, how we do the research, how we find the data to help justify some of our investments. It's a completely free investing masterclass. There's a ton of value in there. All you have to do is register if you'd like to watch it. So if you want to watch this investing masterclass, and as a bonus, we're also going to give you market briefs, which is my investing newsletter for investors. If you want to get my investing masterclass and market briefs, all you have to do is click the link down in the description below. One way to make this a little bit more spicy is by understanding a concept called tax loss harvesting. Some people on Wall Street love doing this, but the whole idea is, let's assume you invest in stocks and you have one stock, stock A, that is up $2,000 and stock B is down $3,000. Again, we're assuming that you've held onto these stocks for at least 1 year. If you sold the stock A and you have a $2,000 gain, that's $2,000 of profit that you have to pay taxes on, but you also have this loss right here. If you also now sell stock B for this $3,000 loss, that means now you're going to take this loss and take it against the gain, which means technically you don't have a gain, you have a loss of $1,000. Now, this is where things get interesting because the IRS says that when you make money from stocks, you have to treat that very differently than when you make money from your job because it's different categories of income. So if you have a loss from the stock market, you cannot use your stock market loss to offset your job income. But there's an exception. If it's under $3,000, you can take the stock market loss and offset your active income from your job. In this case, you have a $1,000 loss and you can take this $1,000 loss against your W-2 job income to pay less money in taxes from your job. Now at this point, you might be wondering, well, Jaspreet, if I just sell the stock B at a loss, can't I just do that and then buy the stock B stock back the next day? That way I essentially don't lose anything? Well, no. The IRS does not allow you to do that because if you buy the substantially same stock again within 30 days, they're not going to allow you to take this tax write-off. But if you wait 31 days, then yes, you can absolutely go back and buy the stock B again. But that's not all that you could do in the stock market. Let's talk about 401ks and IRAs. Now, I'm not going to talk about how you can use a 401k or IRA because there's a lot of information out there already. I want to talk about how you can supercharge your IRA. So 401k or IRA are government retirement accounts. What that means is these are government-backed accounts that you can invest money into, and you have the ability to pay less money in taxes as your money is growing. If you have a traditional 401k or IRA, that means you do not pay taxes when the money goes in, but when you pull your money out of a traditional IRA or a traditional 401k, then you're going to pay taxes when you pull the money out. With a Roth IRA or 401k, you're going to pay taxes when the money goes in, but you generally don't have to pay any taxes when the money comes out. So the money gets to grow tax-free inside of the account. The only difference is, do you pay taxes when the money goes in, or do you pay taxes when the money goes out? For a 401k, you generally have to have a 401k through your employer, but I want to talk about the IRA and different ways to potentially supercharge your IRA. A lot of people like the Roth IRA because they say, I don't know what the tax code is going to be like in 20, 30, 40 years, and I don't want that uncertainty. Or maybe I'll have a lot of income when it comes time for you to retire because I'm building a business or have all these investments. So I'd rather just pay the taxes today, not have any uncertainty, let my money grow tax-free, and then pull my money out without having to worry about the taxes in the future. But the problem with the Roth IRA is they have an income limit. They say that you cannot open up a Roth IRA if you make over $150,000 a year as a single filer or $226,000 a year as a married couple filing jointly. So you're out of luck, right? Well, not exactly. This is where you can take a look at a backdoor IRA. The way a backdoor IRA works is you're going to take your after-tax dollars, just like you would for a Roth IRA, but you're going to take these after-tax dollars and then you're going to dump it into a traditional IRA. Once you put it into this traditional IRA, now you're going to convert this into a Roth IRA. So you're essentially kind of just doing what the rule says, which is creating the traditional IRA. You're just going to convert it to a Roth IRA because the tax code says that you can do this, you just can't do that. Strange, I know, but that's what the tax code says. The second concern that many people have is, well, I can only invest $7,000 a year into my IRA. Well, not exactly. If you have a small business, you have a freelancing company, you are a 1099 contractor, there are ways around that rule as well. For those of you that are self-employed, you can qualify to open up a SEP IRA, which says that you can invest up to 25% of your income, up to $69,000 a year in 2025 into this IRA, and it's going to work like a traditional IRA, which means you don't have to pay taxes on the $69,000 of income today, up to $69,000. So if you make $225,000 a year and you want to invest 25% of the $225,000, that's $62,500 that you can put directly into your IRA without paying any taxes on the $62,500 today, because it works kind of like a traditional IRA. So you get to write off $62,500 from your income. This money goes into your IRA, it gets to grow tax-free, and then when you pull the money out, that's when you have to pay tax on it, but it allows you to invest a whole lot more money in taxes because, again, the cap is $69,000 a year. Now, in case you're wondering, could you do this with a Roth version of the SEP IRA? Yes, as of 2023, a Roth version of the SEP IRA was also released. So technically, yes, you could do this exact same thing with the Roth version of this SEP IRA as well. We're gonna kick things up a notch and make it a little bit more spicy in just a second. But before we do, I wanna make sure we're on the same page. When you work a job, in the eyes of the IRS, that is considered the least risk. And because it is the least risk, you qualify for ordinary tax rates on your W-2 job income, which is the highest tax rates that our tax code has to offer. But when you take risks, such as investing your money in the stock market, well, now you can qualify for lower tax rates on that income from stocks. Then you can make that a little bit more spicy by doing things like tax loss harvesting. And then you can look at things like a 401k or IRA, which allow you to invest your money into the markets and let your money grow tax-free. Again, with a Roth, you pay taxes when you put the money in, so you don't have to pay taxes when you pull the money out. With a traditional, you do not pay taxes when the money goes in, but you pay taxes when the money goes out. But there's some limitations with 401ks and IRAs, specifically with IRAs. Limitation number one is you cannot qualify for a Roth IRA if you are a high income earner, but you can get around that with a backdoor IRA. And limitation number two is there's a limit to how much money you can invest in your IRA, which at the time I'm recording this video is $7,000 a year. But if you are self-employed, you are a freelancer, you're a 1099 earner, you can get around that with a SEP IRA, which allows you to invest even more money into your IRA. So now let's kick things up a notch by talking about real estate. You go out and you buy this $200,000 property. This $200,000 property is divided up into two parts. $30,000 you paid for the land, and you paid $170,000 for the actual building on the property. But you didn't buy this house to live in yourself. You bought this $200,000 house to rent out to another family. And let's assume, for the purposes of this example, that you could rent out this house for $2,000 a month. That means you could make up to $24,000 a year of income, but you got expenses. You got to pay property taxes on this property. You got to pay insurance costs. You got to pay maintenance fees. You got to pay somebody to manage the property, and you might have some vacancy time to time. So let's assume that you bought this property all cash and you can make $10,000 a year in profit. So you made $24,000 in revenue, $14,000 in expenses, and you're profiting 10 grand. You don't have a mortgage. Just for the purpose of this example, the mortgage doesn't really change anything for the tax example that I'm about to show you, so we're going to keep it very simple. So now when you have this $10,000 of profit, normally you have to go to the IRS and say, hey IRS, I made $10,000, and because I made the $10,000, it qualifies for this ordinary income because your rental income is ordinary income. If you sold the property for a profit, that is your long-term capital gains, but that income is your ordinary tax rates. But this is where the IRS says, hey, because you are investing in real estate, you deserve some tax breaks. The first tax break that you get for investing in real estate is called depreciation. And what it says is because you invested in this property, well, every year you deserve a write-off. This write-off is because this property might have wear and tear. Even if your property is going up in value, you still deserve to take this depreciation write-off. And when you are investing in single-family houses, that write-off is 1/27.5 of the property. Why is it 27.5? Well, that's just what the IRS says. If this was an apartment building, it would be 1/39. The numbers don't really mean anything, that's just what the tax code says, but you take this value right here, the value of the property, which in this case is $170,000, and you divide it by 27.5. Again, I didn't calculate 27.5, that's just what the IRS rule book says. You take $170,000 and you divide it by 27.5, and what it says is that I get to qualify for a little bit more than a $6,000 write-off every year. So I have $10,000 in the bank. That's how much money I profited physically. But I get to tell the IRS I get a $6,100 depreciation write-off. This is called a paper write-off because no money is actually leaving my bank account. It's just on paper that for the next 27 and a half years, I'd get to deserve the $6,100 write-off, which means now I have only taxable income of $3,900. This is the money that I pay taxes on, but I can also take this one step further because now I can tell the IRS, hey, I might have some ordinary and necessary expenses to run my real estate business that I need a write-off for. I might need a cell phone to run my rental property business, to communicate with my tenants and my property manager. That could be a write-off. I might need a laptop or a computer to analyze all my real estate finances. That could be a write-off. I might need gas from my truck to go to and from the property to review things. That could be a write-off. I might need a truck to go see my property. That could be a write-off. Those things would then reduce this income down lower, and you only pay taxes based off of what's left. Or if you really want to make it spicy, maybe you'll need to go to Hawaii with your business partner who is your spouse, your husband or your wife. Your husband or your wife is your business partner, and you two need to go to Hawaii and need to go and stay at a nice hotel and eat at some nice restaurants. Those things can be business expenses because if you're going to Hawaii to meet a realtor to look at some property, well, now you're going there with the business mindset to go and look at properties, and those expenses for that business trip are now a write-off. But you gotta make sure you document these things and show how you're going to Hawaii and staying at these hotels for a business expense to look at properties, because if you are, that can definitely be a write-off against your income. Now, I should tell you that making these videos about taxes can be very difficult because this tax code is more than 2,000 pages long and it's, yes, 8-point font. So there are a lot of nuances with a lot of things. For example, we could have a lot more fun with this depreciation. This 27.5 number that I showed you is just the base depreciation that you can get. If you're a little bit more sophisticated, you could qualify for something called accelerated appreciation, which means you made $10,000 of profit, but you get to depreciate $15,000 in year one. Which means if this depreciation number is $15,000, you have 10 grand in the bank, but you take a $15,000 paper write-off, which means you have a $5,000 loss on taxes. Now, remember what I said earlier, this is a paper write-off. You have a $5,000 loss on taxes, but you have $10,000 in the bank. And you can take that $5,000 loss on your taxes against your W-2 job income, assuming you make under $150,000 a year as a single tax filer or $250,000 a year as a married filed jointly tax filer. So you're making money, but you can take that loss to offset your W-2 income to pay even less money on your job income. And if you say, well, Jaspreet, I make even more than that, yes, there are ways to still qualify for that write-off from your real estate paper loss against your W-2 job income. How? Well, number one, you can qualify as a real estate professional. If you or your spouse qualify as a real estate professional, meaning you spent most of your time working in real estate, well, now that spouse or you can qualify as a real estate professional, and now you can take your real estate loss against your W-2 job income. Or if you're using short-term rentals, things like Airbnbs where people are not staying in your property for more than a few days at a time, that loss that you have from a short-term rental, again, it might not be an actual loss, it might just be a loss on your taxes, a paper loss, but that paper loss from your active rental, your Airbnb, your short-term rental, can be used to offset your active income. That could be your business's income, it could be your W-2 job income, and you don't have the same income requirements, which means, yes, you can make a whole lot more money from your business or your job and offset your job income or your business income from your active rental, your Airbnb rental. So now we kind of laid the groundwork of how, in the IRS's eyes, if you work a job that is the least risk, which means they're going to punish you with the highest tax rates. What is that? The ordinary tax rates. If you go out and you invest your money and you get long-term capital gains rates because now you invest in money into stocks, you invest your money into real estate, and you own your investment for longer than a year, now you get to qualify for these long-term capital gains rates. Well, stock market investing gives you some advantages because you can do things like tax loss harvesting. You can utilize a 401k or an IRA. You can do as the backdoor IRA. You can do as a SEP IRA. With real estate now, you can invest in rental properties, and now you get to take advantage of the depreciation deduction, which says as your property gets older, even if it's becoming more valuable, you deserve a write-off. It's a paper write-off called depreciation. That depreciation lowers your taxable income. It doesn't actually lower your income, it lowers how much money you pay taxes on, and then you can write off your ordinary and necessary expenses, which could include things like your phone, your laptop, your truck, maybe even your trip to Hawaii. But then you can get even more advanced with your real estate because you can do something called accelerated depreciation. That is, instead of just taking the standard depreciation, you can find ways with your accountant to take a larger depreciation in the early years of investment property. That way, you're actually having a tax loss. Again, the money is in your bank account. You have an actual profit, but it's a tax loss. Now, you take the tax loss, and there are ways strategically to take that tax loss and lower your active income, whether it's from your job, whether it's from your business. And if you make a lot of money from your job or your business, you might not qualify for a straight loss write-off. But there are ways to get around that as well, which include you or your spouse can be a real estate professional, or you can use short-term rentals like Airbnbs to offset your active income. But now, let's make it a little bit more spicy and kick it up another notch. How about that? Let's assume you're scrolling through TikTok and you see all these real estate influencers driving around in these fancy cars, and you say, you know what? Screw the real estate stuff, screw the stock stuff. I just want to be an influencer. I work a job, but I want to look like an influencer. So you start this TikTok business, you start this podcast, and you just want to be an influencer. Well, to be an influencer, you might have some expenses. You might have to pay for a phone. You might have to pay for a laptop. You might have to pay for Wi-Fi. Maybe you need a couple other things. All that stuff can be a tax write-off for your business. And if your business is not generating enough money to pay for all those expenses, well, those expenses are now a loss in your business. And because your business is an active income, you can use your active business loss to offset your job income. So you start this podcast business, this influencing business, and you're spending $5,000 and you only make $2,000. Well, you have a $3,000 loss in this active business, this podcasting business that you started that you can use to offset this job income. But let's say you want to look like a baller, right? Because you see everybody on TikTok that looks really cool when they're talking about the real estate investments and everybody has this G-Wagon. Well, maybe you need a G-Wagon to look the part as the influencer, because there's a rule in the tax code called Section 179 that says you can deduct heavy vehicles over 6,000 pounds if it is a justifiable business expense. And this is where every specialized accountant, tax attorney is going to be able to ask this specific question, which is, how can your G-Wagon be a business expense? Because if you can say now that you are an influencer and you need to drive around in a G-Wagon to look the part and create content, well, now that G-Wagon is a business expense, and yes, you can write off that expensive G-Wagon because it has to weigh over 6,000 pounds. And yes, G-Wagons weigh over 6,000 pounds. And in case you don't know, Mercedes-Benz has an entire list on their website of all their vehicles that will qualify for the Section 179 deduction. So yes, there are ways to buy these fancy cars and have it be a business expense if you have a good accountant. But let's assume you have a little bit more of an established business. And let's just say that your business is making $100,000 a year. This is a small business. It could be a sole proprietorship, an LLC, an S-Corp. If your business makes $100,000 a year in profit, one of the biggest and best tax breaks for small businesses is the 20% QBI deduction, Qualified Business Income Deduction. And what it says is that normally if you make $100,000 from your business, you're going to have to pay this ordinary tax rates right here. We know that that's the case because if you work a job and you made $100,000, you got to pay the ordinary tax rates. But what the IRS says is if you make this money as a small business owner, the first thing you get to do is qualify for QBI, which is a 20% write-off. So if you made $100,000, you get to take a $20,000 write-off. Why? Because that's what the tax code says. It's called QBI, and now your taxable income is $80,000. You don't have to do anything or show anything besides that it's the small business that you run. Well, now your taxable income is $80,000, not $100,000. So yes, if you are a business owner, you can qualify for this. You can qualify for the other ordinary and necessary expenses, but you have to be able to document everything. The key to be able to qualify for lower tax rates is to document how you're using it and why you're using it and how it aligns with the tax rule book. That's why you want to have a good tax advisor. That's why you want to have a good tax strategist, because taxes can be one of the largest expenses for many people. As you start to earn more money and as you start to be more sophisticated as in earning money from your investments or your businesses, things start to get more complex. You want to get a good accountant, pay money for a good accountant. I spend a lot of money on my accountant, and the reason why I do that is because previously I had a very cheap accountant who I thought was saving me money because I was paying him less in accounting fees, but it ended up costing me a lot more in fines and overpayment in taxes. But when you have a good accountant, it's going to cost you a whole lot more, but it can allow you to pay a whole lot less in taxes 100% legally, because the tax code is a rule book. I hope you got value out of this video. The best thank you is to share this video with a friend, a colleague, a fellow investor. And again, for those of you that are investors and want to become investors, you can check out my investing masterclass. I have that link for you down in the description. Now, I know there's a lot of content on the internet about creating passive income, but 98% of what you see is garbage. If you want to have enough income coming from your investments to fund your lifestyle, it is not going to be easy, and it's not risk-free. Investing has risks, but it is possible. So now, if you're still sticking with me, let me show you how you can actually do it.